There are several types of home loans available to you, each of which have its pros and cons to consider before selecting as your ultimate choice when structuring your home loan. Understanding your home loan options will help you make a confident decision that ensures your financial success. In this video, I'm going to outline some of the most common home loans offered by banks and lenders. Fixed loan. A fixed loan is a loan that has an interest rate offered which may be fixed in or locked in for a set period. For example, you may be offered an interest rate of 4.45% per annum over a 3-year fixed period. If you selected this option, it means that you will lock in your loan repayments for those 3 years and you will only be charged an interest rate of that 4.45% per annum for the duration. The upside of a fixed loan is that locking in a rate can be beneficial when interest rates are rising. As you are locking in your interest rate, this is the rate that is applicable to you for the whole duration of that interest rate term, regardless on how high the market interest rates may get to in the meantime. This will also mean that your repayments remain unchanged throughout the term of your fixed rate period, providing you with certainty of your loan repayments. The downsides of a fixed rate loan is that when interest rates are falling, you would be obliged to pay the rate which you fixed in at, rather than the lower rate that a new borrower could obtain. If you have a fixed rate and you wanted to make loan repayments in addition to your regular repayments, you may be charged an additional fee to do so. Most lenders allow you to repay up to 5% of the principal balance each year without penalty. However, anything above that may cost you, so it's a good idea to not fix the interest rate on all of your home loan if you see yourself wanting to make extra repayments. You can split it and have some on floating. A floating loan is one where the interest rate can move up or down with market fluctuations. For example, unlike the fixed rate, which is a guaranteed rate that is locked in for that agreed period, you can be offered a floating rate, such as 5% per annum for, say, a $500,000 loan. But the rate can change at any time during the term of loan, moving up or down. Because the loan repayments are calculated using the current interest rate, this means that your floating loan repayments are likely to change throughout the life of the loan as well. Often changes in the floating loan rates are related to the movements in the official cash rate. The upside of a floating rate loan is that it provides you with the flexibility to make lump sum payments without any extra costs being charged. Also, if interest rates are declining, you will benefit from the lower interest rates. And if you keep repayments the same during this period of falling interest rates, you could potentially pay off your loan faster. The downsides of a floating rate loan is that your monthly repayment amount may rise or fall at any time. So if you're on a tight budget, this could add a bit of financial pressure. If interest rates increase, so will your home loan repayments. Like an account with an overdraft, a revolving credit is one where money can be deposited and withdrawn up to your credit limit as often as you need. The interest is calculated at the end of each day and charged monthly, which means the lower your balance is on the account, the less interest you have to pay. The upside of revolving credit is that it's useful if you have a regular income, as there are no fixed repayments each month. You can draw down, repay, and redraw money within your credit limit as often as you need. If you're good at managing your finances, you can repay your home loan sooner. You can also reduce your overall interest costs by depositing your salary and wages into this account to pay down the balance. One downside of a revolving credit loan is that if you're not disciplined, it's easy to overspend. It can be tempting to spend up to that limit and stay in debt for longer. Another downside is that the revolving credit interest rates are generally higher than other home loan products. They're a variable rate. Interest-only loans are simply that, loans where the interest is the only portion of the loan that you're paying for. The principal balance, your original loan amount, will remain unchanged. By way of example, if you have a $200,000 interest-only loan with a 5-year loan term, each month you will only be charged for that month's interest, and your repayments will only go towards the interest. At the end of the 5 years, your principal balance will still be the original $200,000. The upsides of interest-only loans is that your monthly payments during the term are low, which frees up cash to be invested elsewhere. The downside is that if you're not disciplined, the extra money could be spent instead of being invested elsewhere, and at some point, interest-only loans still need to be repaid at the end of that loan term. An offset loan is where you can have multiple bank accounts linked to your home loan. The money you hold in these accounts can lower the overall amount owed, so instead of earning interest on these savings, you pay less on your home loan. Simply put, The bank is calculating the interest on your home loan as if your savings have been used to pay down your home loan, or keeping the money available for when you need it. The upside of an offset loan is that you're likely to save money. While you forgo interest earned on your savings are working to pay off your mortgage, which generally has a higher interest rate than your savings account. Another upside is that you can make additional repayments without penalty, because offset mortgages are floating loans and you still have full access to your savings. The downsides of an offset loan is that interest rates on these products are generally higher. The interest rate is floating, not fixed. That means that your repayments can fluctuate with interest rate changes. Other downside of the offset loan is that you won't earn interest on your savings, and monthly fees may apply.